All right. Okay, so it's a couple minutes after. Thanks everybody for joining our webinar. There's still people that'll be piling in. We are at this point just going to kick off. There's a few housekeeping things we kind of want to do to get started. I'll run through introductions, and then we'll jump into a really good discussion. The webinar today was on the interconnection of climate insurance and property values, and we're really focused on this is an extremely topical issue. All of the people in the room have years and years of experience in this space, but we've also had a tremendous amount of demand around the topic following our insurance issue report that we put out late last September. The discussion around the potential pricing of insurance, the impact of insurance on property values, how climate risk is impacting insurance have been questions that people have been trying to put together, and I think we have three people here that can really speak to that at a really high level. So I'll walk through introductions of our panelists. So in order here, Kiran Bhatia is the Senior Vice President at Guy Carpenter, specializing in climate change perils advisory. Kiran joined Guy Carpenter's North America Perils Advisory Team in September 2021. His primary focus is developing their climate change products and supporting climate-related disclosures. Prior to joining Guy Carpenter, Kiran held the role of Climate Science Program Lead at BP in London, England. In this capacity, Kiran was responsible for guiding climate change mitigation strategy, leading on physical climate risk resilience, creating climate science education material for executives, and delivering physical risk information for climate-related disclosures. Before going to BP, Kiran spent nearly 8 years in academia. He obtained his PhD in meteorology and physical oceanography from the University of Miami and a postdoctoral fellowship at Princeton University. His research focuses on tropical cyclone forecasting, severe weather modeling, and how climate change could impact hurricane risk. We're also joined by Dr. Philip Mulder. He's an assistant professor in the Risk and Insurance Department at the University of Wisconsin. Professor Mulder's research focuses on real estate and household finance, environmental economics, and insurance. His research agenda studies how households, insurers, lenders, and governments adapt to dynamic climate risk. Professor Mulder earned his BA in mathematics and economics from Kalamazoo College and his PhD from the Wharton School at the University of Pennsylvania. Philip also recently published a highly impactful article with his co-author Benjamin Keyes entitled Property Insurance and Disaster Risk, New Evidence from Mortgage Escrow Data. Many of you may have seen this in the New York Times, and I'm sure we'll get Philip to talk about it today in our webinar. And Dr. Carolyn Kuski is the Associate Vice President for Economics and Policy at the Environmental Defense Fund. Dr. Kuski's research examines multiple aspects of climate risk management and policy approaches for increasing resilience. She's the Vice Chair of the California Climate Insurance Working Group. She's a member of the Federal Advisory Committee on Insurance at the U.S. Department of the Treasury, a member of the High-Level Advisory Board on Financial Management of Catastrophic Risk at the OECD, a non-resident scholar at the Insurance Information Institute, a member of the Roundtable of Risk and Resilience on Extreme Events at the National Academies of Sciences, Engineering, and Medicine, and many other groups. I cut the list short here just to get the most important ones in there. And she was previously the executive director of the Wharton Risk Management Decision Processes Center, at the University of Pennsylvania, where she also directed the Policy Incubator. She has a BS in Earth Systems from Stanford University and a PhD in Public Policy from Harvard University. And I'm Jeremy Porter. I'm joining as the head of climate implications here at First Street, where my focus is really on the development of economic and social implications downstream from the climate risk models, with the insurance issue being one of those topics. So I'm happy to serve as the moderator here. I'm really happy, as you can tell from the bios, to be joined by the esteemed panel that we have joining us today, and we'll jump right in and sort of start talking through the topic. To do that, I have a couple of slides that we've pulled and built here at the First Street Foundation that I want to share as sort of framing for the larger discussion. So as you know, and we oftentimes set up our own reports here at First Street. Natural disasters are increasing in frequency across the U.S., but even more than that, we're seeing increases in terms of the damages associated with those natural disasters. It indicates that both the climate and the changing environment is both impacting us in the increasing number of events that we're seeing, but also that they're just happening where individuals live. We're seeing that quantitatively in the data that we're collecting in terms of this data, for instance, from the No Billion-Dollar Disasters data set, but also from a number of different resources. There are clear statistical trends that we're seeing in the data associated with both increased exposure and increased damage from climate events. And as we translate that into the actual insurance question on the next slide, I think we've actually been able to think through the role of climate on insurance. We've done this in an aggregate form. We pulled this from our insurance issue report that we produced last fall. And ultimately, we're looking at a hypothetical increase in insurance rates, the black line, which is the first line that you see here, that increases given the restrictions that are often placed on insurance companies within any given state. Here, this happens to be the regulatory restrictions in the state of California. A hypothetical insurance premium raising about 7% per year over the time period from 2010 to 2022. You can see the increase in that rate, but over the same time, we're looking at increases in inflation. We're looking at increases in the cost to rebuild, which are part of the inflation factor also that have been broken out here. Increases in reinsurance, and then increases in actual climate risk. And as you look at what the industry is facing in terms of the actual premiums that are required to address all of the intersecting nature of increasing economic and financial considerations from the larger economy, and then the increasing risk from the climate, oftentimes this is what we're seeing at a national level, that the insurance companies can't keep up in regard to the risk. And we're ultimately seeing the increases in premiums associated with this intersection of the two different components. So this, to me, was really the story that we led in terms of the development of our research around the insurance issue last fall. But now, you know, we understand that this is oftentimes a generalized story, and there's a lot of caveats to this. So maybe I'll start with the question to Kieran, and ask Kieran to tell us a little bit about some of the complexities that are associated with different hazard types, different geographic scales, and some of the patterns that you're seeing in your work.
Great. Yeah, thanks so much. And thanks for the opportunity to be here today. Yeah, so I mean, a lot of times we'll see in the media, as well as in the scientific community, comments about global temperature anomalies and global scale patterns because they're more robust and there's a lot less noise in them. So, you know, we saw, for example, last month, we had the first 12-month period in a row with the average temperature anomaly above pre-industrial, which is, you know, pre-1900s, being above 1.5 degrees Celsius for 12 months in a row. So that's the first time that's ever happened. It was a 12th consecutive month in June of 2024. And then, of course, this past Sunday, I'd be remiss to not mention that, you know, the average temperature was unofficially the highest temperature on record, according to also Copernicus Climate Service. So again, you know, global temperature anomalies are very meaningful, but as much as that scientific interest is there, it's really, how does that translate to local impacts? And that's where the nuance is really important, right? And so a lot of times in the scientific community, we use a technique called pattern scaling, which is basically you translate some of those temperature anomalies globally into what that means to a local environment or a local community or a grid box that surrounds you in a climate model. And that's really crucial. And it turns out that some of these hazards, not all the hazards, you know, they translate, a degree of Celsius translates into double-digit % changes in the actual hazard in your local community. So it's best to understand which hazards and which perils and which communities or regions are showing the highest changes. So I'll just bring out a couple examples of this. So there's been, some recent studies about flood where people have said about a third of the loss increase from that we've seen in the last 20 to 30 years is due to climate change, but about 2/3 of that is due to things like inflation and population increases and exposure changes. Severe convective storm, hail and tornado, that's, something that is definitely on the minds of a lot of us in the insurance industry recently. We did an internal study and we saw that roughly about only 1 to 2% of the loss changes due to hazard changes for that particular peril. And then there's other perils like heat and drought, where we see even higher percentages of loss increases due to the hazard changing. So the first takeaway from that is just, be specific. And it's really important to kind of focus in on the peril of interest when understanding how climate change is affecting the peril. Now, it's undoubtedly there is a large impact, right? We saw, the First Street stat there. It actually, 2023 ended with $28 billion loss events, according to NOAA. And also we saw that, for example, in the insurance, global insurance totals, insured losses 6 of the last 7 years have exceeded 100 billion. So understanding and attributing what percentage of that loss change is due to a hazard change versus an exposure and vulnerability change is really, really critical. And so I would just say that, with all of our analysis, and a lot of people on this call will know, is just be specific to the region, be specific to the peril, because the way that climate change manifests in that local scale can be very, very different than the global change or peril change for another peril that you're interested in.
Yeah, thank you, Kieran. Philip or Carolyn, anything to add to that? Nothing. So I think maybe it's worth kind of just setting the table here. Carolyn, you're an expert in this space. I wondered if you could just tell us a little bit about, from the foundational perspective, what is insurance? Why is it important? How's it used, in industry, and what are the primary mechanisms that we're using in terms of transferring risk at this point?
Yeah, sure. Thanks, Jeremy. Wonderful to be here with everyone. So at base, insurance is a financial tool, right, to spread the costs of severe events over time. So as I'm sure almost all the listeners are aware, right, you have to pay a premium in the good years when you're not facing a loss in order to get a payout to cover damages when you do face that bad loss year. There's now a pretty robust growing body of research that highlights how insurance is very critical to disaster recovery. And part of the reason for that is just that other sources for the needed dollars after a disaster are hard to come by, are really limited, or can take a really long time. We could unpack that, but essentially, most Americans don't have enough savings. There are lots of limitations to our disaster aid programs, and so on. And so when faced with the really severe financial shock that a climate disaster can be, how do households and small businesses cope? And insurance is a really important piece of that puzzle. And we find that households with insurance are more likely to rebuild. They have fewer financial burdens and unmet needs in both the shorter and the longer run. I have recent research with a colleague at Freddie Mac where we also find that as you expand the number of households with disaster insurance in a community, it has positive spillovers, and you see increased visitations to local businesses, for example, after a disaster. And other work with Fannie Mae finding protective benefits to both lenders and the GSEs when households have insurance. So you see this really important financial protection at all these scales, at the household scale, at the community scale, and at the scale of our housing and mortgage markets. So insurance does play this really important role in how we're thinking about how we manage the growing risk of extreme events and some of those figures that were just mentioned.
No, it's super important. I think it's really important for us all to understand kind of the foundational purpose and the role that insurance is playing right now in the climate space, but even beyond that. So that's super helpful. I think one thing, if we can transition just a little bit, Philip, you recently wrote a paper with Dr. Benke's, your co-author, on actual changes in insurance costs. And I think this goes back to the points that Carolyn was making. Insurance is a mechanism that we use to protect ourselves, but currently we're starting to see processes in the insurance industry that are becoming untenable for some people, or can be directly connected back to climate risk. I wonder if you could tell us a little bit about your research and what you found in that space.
Yeah. Thanks, Jeremy, and really happy to be here. Yeah, so as Carolyn was saying, right, insurance has a lot of really useful uh, properties like this risk-sharing financial instrument. The problem is that like someone has to pay for it, ex ante to get that ex post help. So it comes down to premiums. And as my co-author and I were starting to look into how premiums are changing, um, what effects those might be having on folks, and why those premiums are changing, we kept running into a lot of data limitations. Kind of the most of the sort of authoritative, what are people paying for a normal homeowner's insurance policy is going to be more or less data at like the state level, and usually not quite as up to date as you might like to understand some of the most recent trends. So we can see that, for example, the average homeowner's insurance premium is a lot higher in Florida than it is in Pennsylvania. But it was hard to say why, because there's a lot of things that are different about Florida and Pennsylvania. Obviously, one of those is that Florida faces a really high risk of hurricanes. But it's hard, kind of like what Kieran was saying about how do we attribute some of the different factors of losses. It's also hard to say attribute some of the differences in premiums between Florida and Pennsylvania to things like homes are more expensive in Florida, perhaps, or the Florida insurance market faces its own unique hurdles above and beyond the hurricanes, and then how much of that is in fact the expected damages themselves. So what we did, the data that we turned to was looking at records from CoreLogic, which is a real estate data company, on what people are paying for their mortgages. So in that data, what you can see is the total payment that folks send, and people with a mortgage will know that that includes your principal and interest payment, and most of the time an escrow payment, which goes to pay for your property taxes and your insurance, right? So your mortgage servicer is actually making sure that you pay your property taxes and renew your homeowner's insurance policy, because that's part of, the reason they're willing to lend to you in the first place. So in the data, we're able to take that total payment, subtract out the principal and interest, subtract out the taxes, and I make it sound much simpler than it was, but then we're left with the part of that payment that was the premium. So we had a lot of these premiums at the zip code level. And what we did is a technique kind of like when you hear people talk about, say, doing the Case-Shiller home price index, right? These sort of, you're trying to look at, what we did was we looked at for the same mortgage, how that borrower's premium was changing over time, right? So like a repeat loan index, kind of like a repeat sales index to look at changes in home prices. And so the first thing that we saw was just sort of what we see on this map here is the geography of where people are paying their premiums. And there's big differences even within the states. Florida, we needed a separate legend color scale for Florida, but trust me, some of those dark reds in Florida are much higher than others. And you can look even within a county, premiums get, there's a very steep gradient of average premiums tending to increase as you get to areas where, using data from the First Street Foundation, right, we see that there are higher expected losses from the kind of hazards that homeowners insurance covers.
And can you talk a little bit about where we actually got a question earlier, a handful of questions around how are we able to isolate the impact of climate in terms of the insurance, in terms of the work that you're looking at, and potential changes in those insurance premiums from other components, other economic components, inflation, other things like that?
Yeah, so in general, and actually if you want to go to the next slide here. So this was to us a very telling graph. What we did was, right, because we actually know these average homeowners insurance premiums at the zip code level, we sort of broke out the data into 5 quintiles of sort of expected disaster losses. And the first thing you see is that there is this more or less this ordering of premiums of the quintiles. The first 3 are a little smushed together, but then you see the real jump as you go from the 4th to the 5th. And this is all in real dollar terms. So, we're also kind of able to benchmark all of this against just regular inflation. And so sure enough, premiums are growing faster than inflation. It's not just in your head. But a lot of what's really driving that growth is what we see in the very top risk quintile. So there's definitely some caveats here, which is that all we really know about these insurance policies are the premium that folks are paying, right? Are they cutting back on their coverage? Are they buying more coverage? What kind of deductible do they have? We'd love to know that, and there's a lot of really great data collection efforts afoot that I think are really necessary. But this is the snapshot of the premiums themselves. And with that caveat in mind, this increase in the premiums seems to be being driven by folks who are in the highest risk place. So a lot of the rest of our paper is sort of about trying to figure out what might be causing that to happen. And again, with these caveats in mind, it's not so much about the home prices that are different in these areas. A lot, even here, yes, places with faster home price growth, probably for a variety of reasons, saw faster premium growth, but that doesn't really explain this divergence in where premiums went up, nor the full extent to which premiums went up. And then we also kind of look within states, so to speak, right? So yes, premiums went up everywhere in Florida, even in places that are about as low risk as you can get in Florida. But premiums went up even more in the highest risk places in our data. So it does look like that was part of the story.
No, that's terrific. And I wonder if in reading, the research, are there areas that you're uncovering that have really high climate risk, but maybe haven't realized yet increases in insurance costs? Is that something that you came across in the research?
Yeah, absolutely. So again, it's hard to say what's the right or the wrong premium in any of these cases, and I think that's part of why you see so many dynamics here, is everyone's trying to figure that out. So there's a couple factors that come into play. The first one that we see as a real explanatory factor for where premiums went up with risk versus didn't is reinsurance. So when you look at the kind of insurers who write in different states, you see that in some states, the typical insurer doing business has a lot of reinsurance on their portfolio, meaning that they cede a lot of their premiums to reinsurers. So I don't know if this is of course a knowledgeable group, and Kieran of course knows more about this than me. But the one sentence I've learned to say is reinsurance is insurance for insurers. So right, this is, I'm a insurance company operating in Florida, and maybe that's where I do the bulk of my business. The problem is that if a hurricane comes through, I might be paying out a lot of claims at once. I actually want to cede a lot of my business to a larger reinsurer who's doing business globally. What we found out is that from the insurer's perspective, reinsurance can often be costly. Now, of course, they can't diversify the risks in-house, right? So they are turning to it. So this isn't to say that the world would be better without reinsurance or anything like that, but it is one of the costs of writing business when you have these sort of correlated risks in these areas. And reinsurance prices went up a lot over this period. And so you see some markets, and this reinsurance exposure tends to be concentrated in states with a lot of hurricane exposure, and to a somewhat lesser extent wildfire exposure. So reinsurance was a big part of what was driving those premium costs up. And we're not the first folks to comment on this, neither on the reinsurance aspect as being an important part of these sort of movements up and down in premiums. In addition, state level regulation. There are some states that you see in the data are less inclined to approve premium increases when insurers request them. So California comes up a lot in these discussions. And sure enough, it is pretty striking, right? This has been shown in terms of the rate books that insurers submit, but then we also see in the premiums that folks pay, it's a much flatter gradient with respect to risk in states like California, which have more of an active regulatory environment.
Yeah. Kieran, I wonder if you had any thoughts on kind of thinking about the impact of climate on insurance and some of the other influences on the changing price structures that we're seeing currently in the space?
Yeah, I mean, I would say that there's a lot of impacts on insurance and reinsurance from climate. I mean, we do an annual survey of our brokers. We almost had 300 responses this year, you know, basically asking that question about how's the industry viewing these shifts in the marketplace. And there's a lot of the usual suspects on there. Some of the top two are normally advocating for price increases, reducing exposure to certain regions and certain perils. Unfortunately, we see also exiting line of businesses on there. One of the biggest increases we've seen in the last 4 years is we've seen a 4x increase in the marketplace of requiring climate-related disclosures. That's a big one there. So being much more proactive about sharing and understanding your risk. But we also see more creative ways. We see, you know, higher attachment points, reducing hours in loss occurrence, and limiting hours for aggregation. So these are, you know, pretty classic insurance approaches, and then also increasing retention, so higher deductibles. And those are mainly in the physical risk space. We also see some of the transition risk space, which is, you know, we see things like fossil fuel intensive activities starting to be excluded, you know, investments that companies are making for their portfolio. Some of those are becoming much more cognizant of what is a green versus a fossil fuel investment. So all these things are coming up and are slightly in the response category to some of these trends that we're seeing, you know, that Philip just described.
Yeah, that's great. Well, and we talked a lot about trends in premiums and sort of their connection to climate. Carolyn, you've done a tremendous amount of research on communities and resilience and sort of understanding the impact to some of these trends that we're seeing. I wonder if you could talk a little bit about what we're seeing right now in the insurance industry, whether federal or private insurance trends, and how it's impacting communities. How are people dealing with it? What are we seeing sort of in those spaces?
Yeah, sure. I think from the community perspective and the household perspective, that's starting to really get the attention of policymakers and the news media, are kind of 4 big trends over the last few years. And we've touched on some of them, but I'll just kind of consolidate them as kind of from this community perspective. The first is bankruptcies, right? And that's pretty localized right now. A dozen insurers in Louisiana have gone bankrupt. Florida too had 5 liquidated in 2022. The second, which Philip just spent a long time talking about, is higher prices, right? That's everywhere, right? And I think we noted this, but it's also, you know, recently there's been this sort of perfect storm of the climate risk that's driving up prices, but also persistent impacts still out of COVID in terms of supply chain disruptions and labor shortages, as well as our prior period of high inflation, all of which made it more expensive to rebuild after a disaster. When it's more expensive to rebuild, insurers pay more, which means they need more premium. So that's driving up prices everywhere. But then, like Philip was discussing, that, you know, the hotspots of climate risk are even higher than that. But those higher prices are hitting people hard, and we'll come back to that in a second. The third is insurers leaving markets. We also mentioned this briefly. Some of that's been really high profile when, you know, big name companies like State Farm and Allstate leave an entire state, like pull out of California. But of concern, we're also seeing that when insurers don't leave entire states, they might be really reducing coverage in certain areas like high-risk zip codes or along the coast, or other areas like that where the particularly climate-related losses are getting really high. Or, and this is a concern from the consumer perspective, was kind of just mentioned, but scaling back the coverage they provide. So kind of putting more of the risk back onto the policyholder, which can be important in order to just be able to keep providing coverage at all. But sometimes we're seeing that hidden in policy details like sublimits or deductibles. And a lot of consumers just don't read the fine print of their policy, and unfortunately might not realize they have limitations on coverage until they go to rebuild. And then it can be really problematic. So if it turns out you have sublimits for burst pipes or a roof or whatever, and you don't have enough to repair, that can really leave families struggling. And then finally, all of those things are leading to a migration in some of these hotspots of risk from the private sector to the public sector. And I think this is a really big public policy question, right? So we're seeing people who can't find coverage in the voluntary market. All states at high risk have a program in the state. It's often called a residual market, to provide coverage for those folks who can't find it from from private firms, and enrollment in those in places like California, Louisiana has been trending up. Florida has seen a growth in over 200% in their state program since 2018. And of course, I'm sure most listeners are aware that the entire peril of flood is like over 90% covered through a federal program. So we have a lot of government provision of disaster insurance, and they're not immune to the rising costs either, right? So we're now starting to face these really difficult policy conversations about how much do we want to subsidize the risk costs of high risk areas? And do we want to do that for everyone or only for certain types of consumers? There's been discussion about, like means testing in the flood insurance program so that we target our support for lower income households who might need more help with, but absolutely need that financial protection of insurance. And do we want these state programs to be markets of last resort or markets of first resort, right? And those are tricky questions. And I'll just end by saying, I think part of why they're tricky is that we tend to be short-term thinkers as individuals, as policymakers, as private sector firms, right? We're focused on the short term. And the easy answer in the short term is often preserve property values, keep insurance costs low, right? But unfortunately, in this case, that is setting us up for future disruption, volatility, and higher prices. So we face some difficult policy trade-offs right now.
You brought up a really good question around the insurers of last resort and how we're seeing those used in different states. In some places like Florida, the Citizens Insurance Agency has become the largest homeowners insurer in the state. In other states, we've seen the State Fair Plan in California. It's not quite as big, but it's picking up in terms of the number of people that are moving into that space. It's just a follow-up question. What are the consequences of so many people moving to these insurers of last resort, as we call them, in these residual programs? And does it vary by state? I mean, I suspect it's not a national answer. It's probably localized.
Yeah, for these state programs, which are essentially, there's ones for wind and ones for fire, that would be kind of our focus here. We obviously also have one for earthquake in California and so on, but when sticking with the climate perils, I think there's a couple things to note. Like, one is the impact on the consumer. And again, Jeremy, you're absolutely right. This varies by state because they're structured differently in different states. But often the coverage is more expensive or less comprehensive. So it's often sort of not a preferred policy if you can help it. Of course, you're there because you cannot find a better policy or a cheaper policy in the private market. But that's a first thing to note from the consumer perspective. I think the other question is sort of the fiscal soundness of these programs as they're facing increasing risk, and whether they themselves are designed to handle growing numbers of policyholders, and what that means when the big disaster hits for those programs. And again, they're structured differently. So you mentioned Florida, for instance. They're actually set up to cover a lot of the costs of a very severe disaster or series of disasters ex post, by which I mean a big event hits, there's a lot of claims, they can't pay all of them. They go to the bond market and they borrow to pay back those claims. And then they pay back that debt by assessing first policyholders and then almost any property insurance policy in the state. There's a few exceptions. I think it's like medical liability and flood are like exempted. But what that means is that the costs of big disaster are sort of spread among a bunch of lower risk people in the state. So you have an auto policy in North Central Florida, you are going to be assessed to pay the losses to Miami if a big event hits them. And so again, coming back to it raises these questions of, what kind of cross subsidies do we want? Is that how we should be structuring them? And then in Florida, we've been having some conversations there because they actually have 3 state programs, and Citizens is just one of them. They also have a reinsurer and a guarantee association like others who are all designed to access the bond market. What if they all go to the bond market at the same time and the bond market's not as interested or doesn't offer as good terms? And what if you get stacked assessments on policyholders from all of these? So there are these broader fiscal risk questions that I think we also have to really start to address when we're thinking about the system as a whole.
Yeah, it reminds me of the discussion we were having, 5, 6, even more years before that around the NFIP program and the transition to risk rating 2.0. And this almost feels like a transition back to subsidizing insurance in a lot of ways. As you say, lower risk individuals start to take on the cost of the disasters and the catastrophe. So it's an interesting way to sort of think about it. Not that there's a right answer, but there are a lot of things that need to be sort of thought through there. I wanted to kind of transition back into the property value discussion. You brought up the way that it's impacting homeowners. Philip, you've done some work also on climate risk. You did some work a few years back on sea level rise and sort of the lag on impact on property values. I wonder if you could talk a little bit about the ways in which climate risk is impacting property values, but how insurance role plays into that as well.
Yeah, so it's a really interesting question that we're just now starting to dig into, thanks to this new data and more cool data coming around. You know, part of it is that higher home values seem to be associated with higher insurance premiums, but also probably people don't like higher insurance premiums, so they probably that probably does depress home values, right? The question is how much. And I think a lot of folks are trying to get to the bottom of that. One, you know, if you just eyeball it, the home values have actually been going up over COVID, and then some of the supply chain shocks in the same places where insurance premiums have been going up the most. Now, of course, that's not the, you know, all else equal conclusion, right? What would have happened if insurance premiums hadn't gone up as much? That's the question. But I think it is interesting to think about whether people are fully attentive to these insurance premiums, and if they know and are thinking about those consequences as they're buying a home. So as Carolyn said, right, these insurance policies can get pretty complicated. Um, and there's not really an easy tool for you to look up what a home's homeowner premium might be in a specific area. You can get some sense of what insurers write for very generic coverage in different zip codes, but it's hard to really go much beyond that to know if, for example, a property is, you know, being considered uninsurable by a lot of the major carriers at this point, things like that. And we've had this discussion about flood, right? Like you were saying, a lot of this is becoming reminiscent of how we've all spent like the last couple decades worrying about the NFIP. And it's interesting to note how far the NFIP has come in terms of things like making flood maps available online and now risk rating 2.0. Still room to go there. And now we're, as regular homeowners insurance becomes more of a burden for homeowners, I think there's similar challenges of like, how do we make sure that this isn't spilling over onto the broader public? How do we make sure that people get the right information to make the right choices right before it's too late, before you are already, you know, trying to close on your loan and are trying to shop for that first homeowner's quote?
Mhm.
So just to tie back real quick to the case of sea level rise, right? What we saw there is a growing price impact of that particular hazard, which is of course a pretty uninsurable risk. No one's going to give you an insurance claim after your home is perpetually underwater. But it took people some time, and there's some disagreement among different homeowners as to whether or not that really is something that they're worried about in the future. So I think getting the right information out there is a really important part of this problem, and seeing what impact it'll have on housing markets.
Yeah, that's great. And we worked on a paper, Carolyn was part of the research group also with Jesse Gorovich a couple of years back, where we actually looked at overvaluation in the real estate market due to unknown flood risk. So I think that ties in really closely to the flood risks that exist in the area. Insurance really, I think Ben Keys is actually kind of giving credit for this quote, insurance really being the canary in the coal mine, right? Being the first indicator around it impacting residential real estate in particular, and kind of being that first signal in the climate space. So that I appreciate that, Philip.
Hey, Jeremy, can I add a follow-on thought on this?
Please.
I think the issue of risk communication is so important, and one that we really haven't nailed yet. And I just wanted to flag a couple of things. Like, one is that insurance is often talked about as being a really important tool, and Philip and I have thought about this together, for sort of financial signals and information signals. But I just want to remind a lot of listeners, it's only pricing this year's risk. And so it's not actually a great tool to signal where risk is growing over time. And so we need other types of public policy tools to make sure that, as Philip was saying, when someone's thinking about where to live or move, they're they not only need to know what's their premium, what's their risk today, and we're not doing a good job with that, but also, is this an area where, like, year on year, over my lifetime in that home, I'm going to be seeing higher and higher costs of occupancy and higher potential losses? And I know Jeremy First Street has, tried to do a lot in helping consumers get that information about change over time. But I think it's really important to markets.
Absolutely. I think the risk communication point is something that we found also, and we see it in a handful of other research studies. The risk can exist, but if people aren't aware of it, it doesn't become something that, neighborhoods start to get branded as flooded neighborhoods, or, those types of things really do drive objective, empirical consequences around property value and climate migration and things like that. So that risk communication is essential to the signals actually showing up in the data. I appreciate that. And Kieran, is there anything that you can speak to in the larger industry within the insurance industry that that the industry is looking at in terms of making changes around the way it thinks about climate risk? We've gotten a couple questions specifically about insurance providers pulling out of markets and being not so keen to price policies in markets. How's the insurance industry kind of thinking about climate risk and its participation in the market?
Yeah, no, these are great questions. Yeah, I mean, we know that premiums can't just accelerate, and there's a graphic in Philip's paper that came out where it's projections for 2053, I think, and it's triple digit increases in premium for some of those higher risk areas. So the question is, what do we do that's viable long term that will basically reduce the protection gap, make people more interested in insurance and in continuing insurance? So I think, number one is mitigation, right? Where should building or rebuilding occur? How do we incentivize resilience for already existing properties, hardening properties? We partner at Guy Carpenter with IBHS, the Institution of Building and Home Safety, and they've shown a couple of times that building a wildfire hardened home is basically the same cost as a non-hardened home. So how do we get that messaging out there? How do we get that education out there? All this resilience piece is crucial. And then of course, kind of one of my bread and butters is the physical risk side. How we see insurance and reinsurance companies becoming more sophisticated with their views of risk. How do we update modeling to basically capture climate change that's already occurred? A lot of times, Carolyn mentioned that people are just thinking near term. What's the next 1 year, next 5 year look like? A lot of times that people say, okay, then climate change doesn't matter. But a lot of the CAT models we use in the insurance industry, the catastrophe models, a lot of that data is sometimes using 100 years of data. And degrees Celsius change during that is no longer negligible. And that pattern scaling concept of how certain perils scale with a degree Celsius of warming it's quite large for certain perils. So it's no longer, with our views of risk for present day, okay, let's just use what's coming out of catastrophe models and other sources. How do we have a climate adjusted view of risk that is accurate for today? So that's a really big piece of this as well.
Mm-hmm. And you mentioned earlier, actually, in the beginning of the webinar, around the impact of temperature changes on hazard development. I think it sounded like also in this point that you just made that those relationships are nonlinear and they vary quite differently across hazards. So maybe you can talk a little bit about that, kind of tell us what you're seeing in that space, or at least how you think about the differential hazard.
Yeah. So, for the hazard itself, there's now these concepts of tipping points, which basically are capturing non-linearities in the system. So it's basically saying, for example, the first degree Celsius of warming at a location doesn't necessarily correspond to the impacts of the second degree Celsius. So that's purely in a hazard perspective. And that might be a little bit, counterintuitive to some folks, because it's saying, okay, why would, this first degree of warming, differ from the second one? And sometimes it's because this climate system we live in, both the ocean and atmosphere, there's these feedback loops that sometimes, not necessarily always happen, but, certain areas and certain locations that will accelerate things. So a lot of times in the northern parts of our globe, the Arctic, you'll see, for example, this amplification of temperature changes because we have ice melting, which means reflectivity of that surface goes down, which means more solar absorption. And so that warming not only basically increases the temperature of the land, but also decreases reflectivity. And there's a lot of other pieces to the Arctic amplification puzzle. But then there's also, for our industry, in the insurance industry, there's also these nonlinearities that exist in the built environment. And what I mean by that is we see that, with any loss estimate, it's hazard, vulnerability, and exposure. And it might mean that the first bit of sea level rise that, that Philip is talking about, no water is getting into your home, right? So that hazard is getting slowly worse, but your vulnerability is such that that first half a meter or foot of sea level rise is having no impacts on your house. But that second, maybe not even half a meter or 6 inches, might start to mean the difference of a high tide day, water getting into your basement, water getting into your electrical room. And then you suddenly see the losses go from 0 and you get an inflection point or a step change upwards, and you start to see this acceleration of loss. So this is, again, this nonlinearity showing up, and it's really important when we're in our industry is if we get more sophisticated about the hazard, and we see this a lot in the scientific areas, there's a lot of focus on the hazard changes, but how does that change in the hazard really connect to the built environment? That's so crucial to really understanding where those nonlinearities exist in the in our insurance industry.
Yeah, thanks for answering that. That's great. And Carolyn, I wanted to come back to a point you made around risk communication, just communication in general around these topics. We've gotten a couple of questions through Q&A around what is the government and other groups, what are they thinking about doing, and are there any programs in place that could potentially help with the insurance crisis? I guess it's some people call it the insurance issues that we're seeing. But also, if you're familiar with it, what are other countries doing? Is there anything that other people are doing that could be useful that we might be able to do here in the U.S. also?
Yeah, it's a great question. I think there's like several buckets of things we need to do. There's certainly some reforms that are needed around insurance regulation. It's been mentioned that California, for example, is leading some changes right now in their regulatory environment. And we need, as we already talked about, to sort of think about the structure of these state programs. I think that's where we can start looking at other countries. As insurance availability and affordability is getting further stressed in more and more parts of the country, you're seeing increasing calls for some sort of federal role here. And I think that could take a number of forms, and we need to do some more careful thinking on what the different structures mean for outcomes we care about, like incentives for risk reduction and who bears the costs of them and efficiencies and so forth. So that we don't act too hastily before, and have unintended consequences of some policy intervention. But those could take a number of forms. There's nowhere that I can think of that has a fully private disaster insurance market with no government intervention and a high degree of take-up. So there's lots of things to look at how these structures work. And our state programs, as we talked about, are all structured differently from our federal program, which puts and all of those put the government as the primary provider of coverage. A different approach is one taken by like France and Spain, for example, where they require that primary property insurers include all natural hazards in your property, so in your equivalent of like a homeowner's policy. But that, of course, creates bankruptcy risk for insurers, right? Like taking on all that catastrophe risk would be sometimes impossible and certainly make it incredibly expensive. And so they handle that by putting the government at the back as sort of like a backstop or a reinsurer. This is also what the US does for terrorism risk, is sort of put the government in the tail of the loss distribution. So when we get those like really big losses, that's where the public sector comes in and essentially provides payments to the insurance industry to protect them from going insolvent. So that's a totally different role that you could, think about mechanisms here. That also creates a couple benefits for consumers, which is that they have one policy with all perils. Our approach right now of having all our perils like pulled out is really confusing and more expensive for homeowners. So you have to have a homeowner's policy. It doesn't include flood or earthquakes. So if you want those, you have to get a different policy. If you're like on the coast of Florida, you might not have wind, and then you need to go to the state program. And that's like a lot. I think that's a lot to ask of consumers who just want financial protection, right? For like anything that could go wrong. But the reason a lot of Americans kind of bristle at those approaches is that they have a flat fee for catastrophe coverage on all policies. They don't ever raise pricing, right? And we are really firm believers in sending economic incentives about risk. And so, and that's been part of risk rating 2.0 too, right? In the NFIP is that we want, I guess, both from a sort of incentive and a fairness thing, that higher risk people pay higher prices. And that should then also hopefully drive more investments in risk reduction and consideration of location choice. Of course, the challenge with that we've already talked about is that it's only for 1 year. So it's not actually creating the incentives we need for climate adaptation. And so I think for that type of work, we just need public policy intervention. And it's actually my strong belief that the only way to really stabilize stressed markets in high climate risk areas in the long term is transformative levels of investment in managing the physical risk. And that's very easy to say. We need tough building codes everywhere that are not repealed at the time of rebuilding. We need better land use that considers climate risk when siting new development. And we need greater investments in green and gray protective infrastructure. All of that has been a lot harder politically, institutionally, and financially to actually do on the ground. But it's just important, right, that insurance costs more and is less available when the risk is high. So we need to kind of address that underlying risk.
Yeah, that's the great point that you ended on. I think both from a community perspective and a homeowner's perspective is, hardening your community or hardening your home should have some impact on reducing risk. And I wondered, Kieran, if you are within the insurance industry, how is the industry thinking about those the building codes, community resilience efforts, things like that, as they start to think about pricing risk in certain areas?
Yeah, it's still in its infancy, but it's definitely something that's coming up more and more. I think I'll interface it with the science is that a lot of people and a lot of governments are saying, show me that this hardening is going to impact loss. And that actually puts the ball back in the scientist's court and say, or, engineers, scientists, court and CAT modeling is saying, how do you prove that this and what the dollars spent, a lot of times there's a lot of great studies on this, a dollar spent on resilience turns into $10 saved, things like that. How do we show with the best science, the best models out there that this is making a big difference? And I think streamlining those studies, making them more widespread, making them more easy to access for public officials and decision makers is going to be crucial, because I think they want to see that raising a home, hardening the home, that is going to make a difference to loss and make a difference to their pockets. So I think that connection again of having the left hand talk to the right hand here is crucial, because I think that showing the proof in the actual modeling output and doing the high resolution modeling that proves this impact of resilience is going to increase the take up for insurance industries, incentivizing this, insurance companies and reinsurance companies incentivizing resilience.
Yeah. And so we're running up on time, but maybe I'll end with a kind of an open question to the panel. We have a lot of people on the call that are in the industry. We have asset managers, we have consumers, we have people that are generally curious about the topic, academics. What's the best thing for people to do in this space? How can people protect themselves around climate risk, and especially in the certain circumstances that we have now around the changing insurance market? Maybe I'll start with you, Kieran, and then I'll kind of work my way around.
Yeah, I mean, because of some of these experts on the call besides me, I'm going to focus kind of on the physical risk side, and I'll let them discuss resiliency and policy. But we see that climate adjusted views, catastrophe model adjustments, they're all coming, but it's right now in its infancy. I would just say the industry needs more sharing of data, more pooling of resources to get, the best climate model data, weather model data out there and available to a large audience. That's going to be really, really critical. And then also using, climate simulations to isolate the effects of different parts of the climate on loss expectations. So whether that's normal climate oscillations like El Nino, La Nina, Atlantic multi-decadal variability, things like that. But then also understand exactly, use those model details to actually understand what is the greenhouse gas impact versus that. And what does that mean for the next year, the next 5 years? And then also pooling resources to understand vulnerability and exposure better across the industry. I think the theme there, maybe it's wishful thinking, but it's pooling resources to kind of get the best data and the best modeling tools in the hands of many.
Thank you. Philip, do you have any thoughts on that?
Yeah, sure. So I think, dovetailing with what Kieran and Carolyn are saying about the importance of both having knowledge about future risks and hardening adaptation, data sharing, I think it's all really important. And we've talked a lot about people in the insurance industry, scientists, engineers, but at the end of the day, the people making decisions about this are homeowners who are juggling a million things. And, no one wants to live in an uninsurable home. No one wants to pay a higher premium than, their mortgage costs. And I think we would be pleasantly surprised by how much some elements of decision making improve if we just get the right information to homeowners about their current and future risk, kind of combined with the right policy. So I think it's about making it, giving people the knowledge they need and effective communication, right? So that people who aren't professionals in this space can still be making good decisions.
Excellent. Thank you, Phil. And Carolyn, we'll give you the last word to close up the webinar. I think you hit a lot of these points in your last point, but I think it'd be great to hear what you think as well.
Sure. Thanks, Jeremy. I'll kind of tie some of these things together because I think it's exactly right that we need to not think of these things in isolation. So I used to teach risk management, and you really need to bring together the risk communication, the risk assessment that Kieran was talking about, the risk communication that Philip's talking about, with the risk reduction and the risk transfer, and not think of that risk transfer piece as separate from the other three. And I think that's also true when we're trying to get to sort of what we might call climate ready communities that are going to be insurable and habitable and thriving in the longer term. There's not one solution. It's putting a whole bunch of puzzle pieces across sectors together. It's making sure that there's a shared understanding of the risk and looking that risk straight in the face and understanding it, which we don't like to do, but we need to do, with the communication efforts, with the public policies, which is everything from your building codes to your zoning, to your grant programs, to your right? And the private sector coming in and providing all the tools and products that we need as well, along with a strong workforce who can do the things like build stronger homes and green homes and the infrastructure that we need. So it's about getting all of that together into sort of a shared understanding of climate risk management.
Excellent. Thank you, Carolyn. And so we're right at 1 o'clock. I want to thank the panelists for joining. I really appreciate the diversity of perspectives. I think all of you really added to our understanding of the topic. And as we sort of close up, we are at First Street committed to a lot of the risk communication topics that Carolyn brought up. We're also focused on the ways in which our data and our products fit within the larger framework of asset management and risk analytics. So we're, just in terms of understanding the data, understanding the risk, understanding what types of products we have. We always like to end these webinars by saying, feel free to reach out to us. We're constantly engaged with experts, like the experts on the panel today, to deepen our own understanding, but also in the thought leadership space, so that we can continue to develop products that speak directly to things like the climate scenario analysis and risk analytics and other property level analytics that we're seeing. So again, I'll close with that and say thank you again, everybody, for joining. It was a terrific discussion. I learned on the webinar. I hope others that attended did also. There was a note that was sent out. We'll share the webinar recording. We'll answer questions that came in and share those out also with participants. But thanks again, everybody, for joining the webinar, and thanks to the panelists for spending the hour with us.
Thank you.
Thanks, everybody.
Thanks.